Welcome back to the channel. A lot to unpack this week, a lot to talk about, especially with the federal budget, the Liberal government releasing its $54 billion budget, and ultimately the deficits that come along with it, the $19 billion that is going to be now allocated to addressing the housing crisis and the housing plan here in Canada. We'll talk a little bit more about some of these capital gains implications. We'll talk about that 30-year amortization and some potential changes coming down the pipeline when it comes to fraud prevention and mortgages. And we'll touch on those CPI numbers that came out earlier this week, coming in at 2.9%. It seems like all that data got shadowed by the federal budget, but we'll unpack that and more this week. So we welcome you back to the channel. Thanks again for stopping by. It is Friday, Finance Fridays. I'm your host, Anthony, with InTouch Mortgage Solutions. And if you haven't subscribed to the channel, we invite you to go ahead and do so. Hit that notification bell so you get notified every time we post our new video. As well as don't forget to like, share, and leave a question or comment in the comment section below, and we will answer them in a future episode. But let's get right into those CPI numbers. I think it's important to start off there. Earlier this week, at Tuesday, we definitely got a little bit higher inflation than many had expected, especially looking at 2.8 for February, 2.9 in March. It did beat out expectations. Many economists did position that inflation was going to come in at 3.1 or 3.2, so that's good news, coming in at 2.9. Why did inflation come in at 2.9? Well, a lot of it is to do with, obviously, fuel prices. Higher fuel prices caused inflation to spike, and ultimately, we're still seeing that elevated pressure from mortgage interest cost, higher rents. And what is the good news, the good takeaway from all this is that core measures of inflation, CPI medium and trim, things that strip away volatile items like food and energy, well, those numbers have been rolling over month, and that is exactly what the Bank of Canada wants to see when they think about aligning their expectations and forecasts with a rate cut. They want to see those numbers come out, but I still think we're a little bit ways away from June, where that potential, that realm of a possibility will be. A lot of data still needs to roll out before that happens. What type of data are we expected to look at? Well, ultimately, a few things that we should pay close attention to. What is happening just on the other side of the border in the US with their actual consumer spending going up, and ultimately their economy still being very robust, very resilient. The conversation around accelerated inflation in the US is a problem, because if the US does not cut their rate, well, that's going to have an impact on Canadian fixed rate mortgages, as we've seen unfolding over the past little while. We've definitely seen these bond yields tick up. The 5-year Bank of Canada bond, which is the barometer for 5-year fixed mortgages, has definitely increased 50 basis points. And this is something that is allowing banks to now increase their fixed rate mortgages or remove some of the discounts that they would have been providing to clients as these bond pressures continue to wreak havoc on fixed rate mortgages. But ultimately, another thing we have to look at is what is happening in the Middle East. That is a big topic as well, because if we see some tensions continue to mount, that could impact OPEC oil and maybe have some supply chain disruptions that we could see that could ultimately impact inflation. Remember, the Bank of Canada, even the US, everyone wants to get that inflation target back down to 2%. We are within that bandwidth. But when we think about now shifting gears into the budget, well, with all this new spending, this new stimulus, well, stimulus has a tendency to stimulate. And even with, a couple $2 billion a year being, dredged out over the next little while, we see this budget, $54 billion, all this new deficit spending, $19 billion being allocated to the housing crisis. Well, we don't know what the impact is going to be just yet, but we can pretty much rest assured that it will be inflationary in nature. And this is something that the Bank of Canada has warned against. And with all that, how are they planning to fix the problems here in Canada? Obviously, the Liberal government has failed to deliver the promises, their electoral promises that when, voted in 2015, they wanted to bring affordable housing to young Canadians. And it seems that for many Canadians, they feel deflated. They feel that they're not able to enter the housing market or actually afford rents under these new guidelines. So the government is now, in a last-ditch effort, in my opinion, trying to win over these voters by saying, look at all the things we are trying to do. While they had 8 years to sort of do this, they're just waiting until the last minute in typical fashion. But ultimately, what are some of these plans? So there's a lot to really unpack when you think about not only the budget, but this Solving the Housing Crisis Canada's Plan. It's another additional document. It's around 28 pages. This outlines sort of the housing plan, what they plan to do with it. So I want to touch on a little bit about that particular plan, because that relates more to the housing front, as a little bit of mortgage changes and regulatory changes that could be coming down the pipeline. The first thing that we definitely heard about just last week was this 30-year amortization. Now, this is something that on the onset, on the outlook, looks really promising. It could potentially have moved the needle for a lot of Canadians, but it's really not going to move the needle for most of Canada, especially those that are looking to get into the housing market right away. So what are some of the context? What's the context within this 30-year amortization? Just to break it down very simply, it is still an insured product, which means it has to meet the insurer guidelines, has to be sub 1 million. You have very stringent qualifications to fit the insured guidelines. That insurer could be CMHC, Canadian Mortgage and Housing Corporation, SAGAN, or Canada Guarantee. But more importantly, for the 30-year amortization to be applicable, the buyer has to be truly a first-time buyer. They have not owned a property in the past. They also have to be buying a newly built or newly constructed home, which means you're buying a home on paper, a condo that could be closing in a few years, a home that might be closing in a year or two. Ultimately, that is what is required. Ultimately, you can also build your own home as long as it fits within those guidelines. Now, of course, increasing the amortization from 25 to 30 years creates a little bit more of a window of affordability, because depending on the size of the mortgage, you can definitely use the mortgage calculator, which is in the description box below, to take a look at some of those options. But it could be anywhere from a few $100s a month savings between those two different components. And that could actually move the needle for some Canadians, and depending on the price point of the home that they're trying to get into. Ultimately, if you're stretching that budget over to the $1 million mark or close to that $1 million mark, the income, the affordability, the wages are required are really, really high to make that work. But you have to recall that the builders themselves, the Builders Association, was the ones that were fighting for this 30-year amortization. They've basically got the government to do this, which is good. I mean, this is a really good thing, because out of this, I really think that developers may start to build more projects, seeing the potential easing in the qualification. Remember, builders have requirements. They have to also finance. They need to get skilled trades, which is something that's in this plan. They need to train more skilled people to build the homes. They also need to get better permitting issues resolved, in the sense of, like, now the government wants to sort of cap all these costs. Remember, when you think about how much of the cost to build a home is actually going to the municipality, to taxes, so on and so forth, it's around 25%. So if they can stabilize that, maybe we will see more builders building these projects, these homes for end users. But I think for a lot of Canadians, it's going to be in a lot of the other provinces outside of BC and Ontario, like we're seeing happening or unfolding right now in Alberta, where you're seeing homes that are still achievable at around a $400,000 to $500,000 price point, maybe even lower if you're looking at condos. And that is actually creating affordability. Here in Ontario, some of these hotter pockets where land is a little bit more expensive, maybe those homes are going to be much higher. And ultimately, how many homes at that price point is the builder going to build? How many homes can they build at that price point? And how fast will those be gobbled up by Canadians, and definitely pushing up those home prices? That is going to be the $1 million question. Now, the other thing within this conversation around the 30-year amortization that's worth noting is that they will leave the door open for further changes to this 30-year amortization. And whenever you make things a little bit easier, you definitely have an unintended consequence. That's going to obviously drive more potential Canadians off the sidelines that maybe didn't look at it. Maybe now they're going to look at buying a new home. This could ultimately open up the door for maybe a 30-year amortization for resale, maybe a 30-year amortization for newly built homes for non-first-time home buyers, right? Because as of right now, maybe you're aware or not, insured mortgages, if you buy with less than 20% down, you don't have to be a first-time home buyer. You could be a second, third-time home buyer. As long as you fit the guidelines for the insurer program, you can still buy a home. You can have multiple homes that you've bought and sold. As long as they're not an investment, you can't buy an investment property with an insured product, but you could have bought a home, kept it, buy the next one with an insured product, no problem, as long as you pay the premium. So we'll see how these particular doors maybe open. Maybe they'll make some changes there. Speaking of changes, in the budget, they were talking about potentially allowing insured refinances. So right now, you can't really refinance a home unless there's about 20% of equity in the home. So you can't go insured, you can't go past that. So to simplify it, they may now allow refinances to go up to $1 million, but it has to be for the purpose to remodel the home, to retrofit it for maybe more units, to allow you to rent out some of the floors in your home. As you may recall, just a little while ago, some of the municipalities, especially Toronto, did allow homes to be now converted into a fourplex. And this is sort of the idea. They're toying with it. If these are actually going to come into effect, will be very interesting to see. But the 30-year amortization is coming into effect on August 1st. That is 100% happening. We'll see how these things play out. We'll see how good this program is. If you do recall, it takes time to see if the program will actually be worth its weight. Remember the first-time homebuyers incentive plan that was launched a while back with that shared equity? All that failed miserably. But I think this one's a little bit better, but I don't think it's going to move the needle for all of these first-time home buyers, especially when you think about where you're buying. So let us know what you think in the comment section below. But now I want to move over to the fraud component. I think this was really, really big. And ultimately, amongst real estate and other things, mortgage fraud is something that we're a big proponent of. I think anytime you can even out the playing field for those Canadians that are doing the right thing, buying a home with the right paperwork, it is always good. So now the conversation is revolving around CRA, the Canadian Revenue Agency, CRA, and the banks being able to communicate with each other to validate and verify income documentation. And this is a really good step in the right direction. I think maybe there's an AI play here because the government is spending billions of dollars in AI, hopefully to build better homes and maybe cut out all these consulting fees. Hopefully it creates jobs, but ultimately I think there's going to be some type of coordination here. Okay, so if you're a Canadian, you may be asking yourself the question, hey, what happens in these situations? I'm salary, I'm self-employed, I'm commission-based. Well, you're going to need to show the income. At the end of the day, this is exactly what the government wants. They want their tax revenue. They want to collect from Canadians what is rightfully, their tax equivalent, right? What they need to be paying. And this will also allow Canadians to, potentially buy a home, because you're able to show the income and the CRA is able to validate it. And this is going to avoid anyone that's trying to falsify documentation with what CRA has on file. It could trigger maybe a warning. Who knows how this is actually going to play out. But for Canadians, like a lot of clients that we've worked with, a lot of clients that come to us first-time home buyers, maybe they were in a different position in a job, and now all of a sudden they've gotten a promotion, their pay has bumped up. How do they look at the qualification? Well, right now with banks, ultimately, we have to look at T4s, we have to look at your notice of assessments. If you're self-employed or commission-based, you're looking at your T1, your tax filings. What did you show as income? And ultimately, if your salary or you've gotten guaranteed hours, you can always use the income based on the job letter and subsequent pay stubs. So I think there is still an opportunity. I mean, ultimately, this is the good thing is first-time homebuyers don't have to be discouraged by this, but that still does leave the door open for, shysters and fraudsters to still conduct themselves. But I think it will actually limit or pull back those who are trying to really gain the system. So let us know what you think about that in the comment sections below. But let's just jump in really quick to these capital gains conversations right now. And I think it's a very important conversation. Now, I'm not a tax professional or, very proficient in tax code, but any time that we look at taxation, either on the wealthy or corporations, it begs the questions of what the unintended consequences could be. So just to be very clear, the capital gains implication is not for primary residence. So if your owner-occupied home does not apply, it is basically for investment properties or maybe secondary homes like cottages and obviously investment properties. So that comes into effect June 25th. And obviously this is going to move the needle if you're over $250,000 in capital gains. There's a lot to really unpack here as we move the needle. I think they haven't touched this particular code for about 23 years. The other conversation is whether or not a new government that comes into power, if elected, will they revert or reverse back on these particular plans? Because a lot of individuals may say, yeah, tax the wealthy, they have the money, which is fine. That's definitely the case. The wealthiest people in Canada do pay their fair share, or most of them do pay their fair share of taxes. Ultimately, they are the biggest drivers of the economy. But we have to look at the unintended consequences when you try to strip away business incentives, when you try to strip away these particular clientele, these particular people. Why is that important? Well, if we just take a quick second, look at the US to Canada. The US is a very business-orientated economy. They give a lot of incentives to businesses and corporations to set up shop. When you look at this from a bird's eye view, would you want to be going to a place like the US or Canada where you're going to be taxed so heavily and takes away productivity, which is a big problem in Canada. We've heard from the Bank of Canada Deputy Governor Carolyn Rogers just a little while ago about the productivity crisis in Canada. We're not creating the proper tools, the vehicles for investment, foreign investment, to create this productivity in Canada, to bring up the standard of living. And by increasing the taxation on the wealthiest, on these corporations, particularly, not talking about investments, but we're talking investment properties, we're talking about corporations. So this is something that we have to understand. This is going to basically allow people to practice tax avoidance. It's going to allow people to not show as much income, not be as driven to create this wealth or to open up businesses to create employment. There's so many different knock effects on doing this. Ultimately, this is something that we have to really pay close attention to. Yes, we could see a lot of investors right now that are sitting on properties, especially those that are maybe in a corporation, not personally held, ultimately maybe liquidate some of these properties and bring them to the market. It could push inventory levels higher in the short term, but ultimately we'll see exactly what happens. There's a very short window between now and June 25th. We'll see exactly how these particular capital gains implications play out. But just remember, it's not for primary residence. It's just for investment properties, second homes, and obviously for corporations that generate over $250,000 of capital gains. So let us know what you think about that in the comments section below. Ultimately, this is a big conversation right now. The budget is rolling out. It all takes time. You know, in that solving the housing crisis plan, you know, there's so much talk about the GST, obviously infrastructure spending, capping fees, bringing more projects to the forefront. You just have to understand that this takes time. It's not going to be something that's going to be solved overnight. And keeping in mind that there's an election coming up in 2025, the tail end of 2025, if not before. But ultimately, this particular conversation, I believe, is just a way for the current government to buy votes, to show face with its constituents and its individuals that still have faith in the housing crisis here in Canada. And ultimately, do you think it's going to really solve the problem? Do you think spending billions of dollars is going to make things more affordable for future generations in the coming years? I mean, that is the ultimate question. Who pays the ultimate price for these particular expenditures today? So let us know what you think in the comments section below. But we'll leave the video here, wishing everyone a wonderful Friday. Thanks again for stopping by, and we'll see you next week.